Good morning from our global headquarters in New York. I'm Manus Cranny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set that agenda.
Bonds remain under pressure as weak auctions and election uncertainty dominates. Alphabet kicks off this week's big tech earnings. $20 trillion in market cap will report in the next 3 days. And leaders gather in Riyadh. We're going to bring you our exclusive interview with David Solomon of Goldman Sachs. Good morning, Manus.
Danny, good morning. These markets have all the hallmarks of prepare for Trump, hedge for Harris. We're flat at the moment. I love what Matt Petersen, our guest later on, says. Underestimating U.S. capitalism could be fatal. Alphabet reports today you haven't had a down day of more than 1% in a month. We haven't seen that, in this month of October, since 1968. The beats are coming, but they're not hard and fast enough for Laurie Calvasina over at RBC. Roll it over, have a look at the bond market. Yes, the 2s and 5s tailed. They had to make it a little bit cheaper to get them away, a little bit of a wobble. Wouldn't you wobble ahead of this election? We've had a small indication of the first quarter refunding, $823 billion, 10% higher than the start of the year, Danny. But no bond rally in the face of a massively declining oil market. And we just haven't seen that for quite a while, for a few years.
A 6% decline in oil, the largest in 2 years. I think it is so telling that you had bonds under pressure, to your point, to do that. Is this more pricing in of not just a Trump presidency, but a Republican sweep? The betting odds, which we've talked about, quite idiosyncratic, have pushed up something to like a 48% of a Republican sweep. And that's given us the more juice and yields.
How much more juice is there in the equity upside if it is a Trump and a red sweep? Just listening to some of the voices in Riyadh, Larry Fink warns that we have greater embedded inflation in the world than we've ever seen. Maybe that's also a protagonist for these higher bond yields.
I'd say one of the symptoms of all this uncertainty has been the reaction to stocks to earnings. They've been swinging like crazy. Tesla, Netflix, Lockheed Martin, all of them are rising or falling more than 10%. It just shows that this is a market on edge.
Well, Alphabet is in our sight line today. Let's take the proposition of how to prepare for the next 10 days to Seema Shah. She's the Chief Global Strategist of Principal Asset Management. Seema, good to have you with us. We're talking about prepare for Trump, hedge for Harris, but it's a starting point that matters probably the most. You had a 15-month rally after Trump came to victory in 2016, but the market was trading at 1.8 times then. Now we're trading at 3. How much more mileage is there if you have a Trump victory and or a red sweep?
Thanks, Manus, for having me on this morning. It's a really interesting question because I think there's a lot, of course, there's a number of similarities to 2016. One of the key ones, though, is that a Trump victory at that time was a complete surprise. So, of course, after the result, you did have a very significant market reaction. In this situation, markets are already betting on a Trump victory, so it wouldn't be as much of a surprise, I guess, and you wouldn't expect to see such a violent market reaction. But to your point about where the market is today, as you said, we have seen a tremendous rally in equity markets over the past couple of quarters, couple of years, in fact. So there is actually very limited room for the market to continue at this kind of pace. Valuations are very extended. So although I think it's a very positive economic outlook, I think investors are starting to look at the number of stocks and say, well, look, do we want to be going into a market which is really expensive? Can we honestly expect to see very, very significant gains from here? Or are we looking at a little bit more measured pace as we continue over the coming months?
Seema, you know very well, though, that if you tried to invest just based on valuations, you would have missed a large chunk of rallies over the past few years. What makes this time different?
So you're absolutely right. And I think that is key. If anyone had just looked at valuations and then they would have stayed away from the Max 7, they would have stayed away from US equities. And we know that that would have been a horrible decision to make. I'm not saying that this is very completely different in that regard, because, of course, if you were once again to look at valuations, you would be looking at other markets around the world and completely ignoring the US. I think that what this is telling us, though, is that from here onwards, it's going to take a little bit more of a positive surprise to get that catalyst to push the market significantly further forward. And at this stage, the market is already pricing in pretty good news. It's pricing in a soft landing. It's pricing in some Fed cuts. And it's pricing in a general global stimulus wave. So from here on, it's difficult to see what's going to surprise to the upside that is going to give that very significant push high, that you get that meaningful gains like we've seen over the last 15 months.
Listening to Larry Fink in Riyadh in the past 20 minutes, we have greater embedded inflation in the world than we've ever seen. And I think we're going to see interest rates as not as low as people thought. That embedded inflation risk is something that we don't spend a huge amount of time talking about. We talk about a no landing, but this is a concept which can provoke a very different response from the Fed next year?
So I kind of agree. I mean, in a way, yes, inflation, as we look out, not just over the next year, but if you're looking at over the next 5, 10 years, it certainly seems like inflation is going to be higher over the next 10 years than it was over the previous 10 years. And there's a number of structural reasons that Larry Fink has obviously laid out. In terms of how the Fed responds to this, I think the one key takeaway for us is that you're very, very unlikely to see rates coming back down to zero. This is a higher for longer. But it doesn't necessarily stop the Fed from moving forward with rate cuts, at least taking them towards neutral.
Yeah.
So I think that, it's a concern in some ways, but I think it can be exaggerated because we're not expecting a spike in inflation. For that, you need to have another supply chain emergency, or at least some kind of demand shock as well. And I don't think that's on the cards for now.
Seema, you're talking about the medium term. I want to know about the near term. When the Fed has a decision to make 2 days after the election, when we might not know who will be the future president, nearly a week after jobs data this Friday, when the lowest estimate is a negative print by Bloomberg of 10,000, Bloomberg Economics, and a medium of 110,000 skewed by strikes and weather. What happens on November 7th, and how should we react to it?
So this is a pretty difficult time for the Fed, and not even just the next couple of months, but actually even if we look out over the months ahead, the data is somewhat compromised. You mentioned the strikes and the weather. There's also a declining response rate in a lot of the labor market data, and then throw in the election on top of that. But I think for the Fed, there is a risk that they're flying blind almost, especially because they are data dependent. But certainly from our perspective, if you're looking out over the next 6 months or so, and we can say that, look, household balance sheets look pretty strong, corporate balance sheets look pretty strong. So is there a risk that this is going to turn into something really negative? Probably not, but we do know that rates are pretty restrictive, and the Fed needs to keep going. The other thing that we are taking away from this is that if we look back over the last couple of months, the one thing that the Fed did repeatedly say is that they don't want to have a stop-go cycle where they start rate cuts, and then they stop and then maybe even hike again. That is something that they're really looking to avoid. So that does give us some reassurance, and at least in the November and December meetings, we should expect to see 25 basis point rate cuts. From January, you do start to introduce a little bit more uncertainty because we need to see how the economy is panning out. But I do think they're going to look through the noise, or at least I hope that they would look through that noise.
Yeah, they're going to have to try and look through this sort of potentially dirty number with various hurricane and strike issues in it. We're counting down to some of the biggest Mag 5 out of the Mag 7 this week. Alphabet is on the slate today. Yesterday's conversation was around CapEx, which would embolden or add to the momentum of the Mag 7. How important is the CapEx number? What are you going to be looking for in Alphabet and the other hyperscalers this week?
I think it's pretty straightforward for a lot of these companies. We just want to see, are they delivering on these really lofty expectations? I mean, one thing that has been interesting to us, if you're looking back over the last couple of months or so, is that whereas once upon a time, the Mag 7 would do well if the market sentiment is obviously very strong, but it would also do well if the market sentiment was quite weak because they'd be looked at as a bit of a defensive play. I think since July, you've seen a slight change in sentiment or at least change in the way that they performed, where if market sentiment is weak, actually the Mag 7 do start to struggle. So, they're leaders of the market, but they're also becoming a little bit more responsive to broader investor sentiment. It is important that they do meet those lofty expectations. If they don't, then I think it's going to give a lot of people cause for concern. And then, of course, hopefully, maybe see investors start to think about what other parts of the market can do well, where valuations are a little bit more attractive.
Seema, really great to get your thoughts. Thanks for your time this morning. Seema Shah of Principal Asset Management. Manus, let's get to some of the other top stories trending on the terminal this morning. Boeing raised around $21 billion in an expanded share sale. It was an effort to shore up its balance sheet and one of the largest ever sales by a public company. The infusion of funds clears one of the new CEO, Kelly Ortberg's most urgent tasks amid a period of financial turmoil and threats of credit downgrades.
Bankers at HSBC can expect to share in a 2024 bonus pool worth at least as much as last year's haul of $3.8 billion. Now, a higher pay pot contributed to a slight bump in the bank's operating expense in the first 3 quarters, along with inflation and its continued investment in technology.
Santander posted better than expected profit in the third quarter. The Madrid-based bank is among European firms potentially most affected by the global shift to lower interest rates. So executives are turning to job cuts and risk transfers to help control costs.
Coming up, Ford trims its profit forecast. We take a look under the hood.
And later in the show, it's a big week for big tech. Mads Petersen of Human Edge Investment Technology is staying overweight on the sector. He will join us around 5:30 a.m. New York time. Stay with us for that. It's your Bloomberg Brief. Danny Berger and Manish Cranny in New York. So Ford this morning, the stock is sputtering, to put it lightly, down 6% in the pre-market trade. Its full-year earnings will be at the low end of its forecast. The automaker also facing struggles from warranty costs, supply disruptions due to the recent hurricanes in the U.S. Joining us with more is Bloomberg's Craig Trudell. Craig, how much of this is just auto problems in full for the sector, woes, what have you, versus Ford-specific idiosyncratic issues?
Yeah, I mean, I think it's really sort of more of the latter. I think we entered this earnings season with a lot of pessimism for the industry. I think particularly over here in Europe, right? I think we're seeing sales really under pressure, concerns about compliance with tougher CO2 regulations in Europe. In the U.S., it's been a bit of a different story, and I think we can look back to GM earnings just last week where they really sort of blew numbers out of the water. Tesla also did quite well in the past quarter, and so this is a case of Ford really kind of diverging from the pack a little bit and falling behind because of familiar issues.
Well, they're not just falling behind either. They're going to lose about $5 billion on electric vehicles. Obviously, the CEO here should be looking over his shoulder and looking at Mary Barra and saying, right, she took remedial action perhaps a little bit earlier. What else can Ford do to close this gap in remedial action? I know they've got issues with warranties, but what's the other alpha they can do sooner?
Yeah, I think this is a case of needing to get Ford's house in order in terms of their electric vehicle business. To your point, I think they tried to maybe sort of cut corners a little bit and were caught off guard by the impending arrival of electric pickups that were going to potentially threaten the F-Series franchise, which that is absolutely the sort of crown jewel of the company. And it still is in terms of a combustion vehicle, but we haven't necessarily seen electric pickups take off. I think Ford really tried to kind of steal a march on GM and rush a pickup to market that was largely based on the combustion truck platform. Didn't try to do a sort of dedicated electric vehicle. Their own, batteries, battery powertrain, the way GM pursued with Ultium. That hasn't worked out well in terms of for the consumer or for the company in terms of the sort of attractiveness of the product or the profitability of the vehicles. And so, I think that's a real issue that's going to take them some time to resolve. And then if you're Jim Farley, I think, he's holding up newly launched vehicles until the company can get its house in order from a warranty perspective. That continues to be a vexing issue for this company where, they're just underperforming relative to their peers, GM in particular, because of that issue.
Yeah, well, they're 300 basis points under in terms of margin as well. Craig, thank you very much. Craig Trudell in Berlin on the Ford story. Coming up in the show, go out, get yourself into the office. That's the message at Starbucks. A major push, I'll get there. A major push for people, it's the triptych of P's, to return to the office. Context matters on Bloomberg. Bloomberg Brief, I'm Manish Cranny alongside Danny Berger here in New York. The leaders in finance and tech, they're gathering in Riyadh for the Future Investment Initiative. Bloomberg caught up exclusively with the Goldman Sachs CEO, David Solomon, on the state of the U.S. economy. Let's take a listen.
The U.S. economy is actually doing quite well. It's been very, very resilient. I'm a little bit more concerned about European growth and also the economic situation in China. But overall, the engine of the U.S. has been quite powerful, and our business, while global, is quite correlated to U.S. growth. I can give you a list of things to worry about, but generally, I can tell you also a list of things that I'm quite optimistic about.
Yeah.
The progress around technology and AI and the opportunities to increase productivity are real. Progress that we're seeing around healthcare and medical technology are extraordinary in the impact that they'll have. So there are a lot of reasons to be optimistic about the growth and trajectory of economies around the world.
Yeah.
But there's also fragility and things can go wrong.
Well, I was going to pick up on that because it's been really difficult to sort of track the narrative around the U.S. economy the last few months because we've gone from hard landing to soft landing. Now people are talking about no landing. I'm not going to ask you for a descriptor of the U.S. economy, but what I will ask you is where are some areas of concern that you're seeing right now?
Well, the base case in the U.S. is certainly at this point for a soft landing. That doesn't mean that at some point there can't be, some sort of a slowdown in economic growth. But what I would say is the U.S. economy is proving to be incredibly resilient. We do have an election in the U.S., and there'll be policy decisions that come out of that election. And so, certainly those will have an impact on the trajectory in 2025 and 2026. With respect to, European growth is more sluggish at the moment. And I'm concerned about the same things that many people I know are talking to you about at this event. Geopolitics, U.S.-China relationship, the situation in Ukraine, the situation we just touched on in the Middle East. Also concerned, broadly about inflation in the world, concerned about energy policy, which is obviously a significant issue. I'm concerned about immigration and migration, which is an issue in different parts of the world. So these are all issues that require leadership and policy direction. And I'm hopeful as we get past the election in the U.S. and we continue to move forward, we'll see a clear direction of travel on some of these significant policy issues. I think there's an awful lot of attention on short-term rates. I'd actually be focused over time on longer-term rates. And, I continue to be concerned about the level of spending and deficits in the United States. I don't think that's a short-term, crisis factor, but unless we have policy change and get our spending and our debt under control, ultimately that's going to have a bigger impact on long-term rates than I think people are anticipating today. With respect to the short end of the curve, I think it's going to be very data dependent, and that data will be driven in part by what kind of policy we see coming out of the election.
Yeah.
And so I think it's important to watch carefully. It seems like the Fed has been relatively transparent that we'll get another interest rate cut before the end of the year, but after that, I think it will be very data dependent on what kind of policy implementation, what happens to growth, are the inflation numbers actually improving further? Those are all things I think the Fed will be watching carefully.
Can I just circle back to your first point vis-a-vis spending, though? 10-year Treasury is trading around 4.3%. Do you think that is adequately pricing in the fiscal premium in the years to come in the U.S.?
The market's the market, and so it is absolutely pricing in the premium that the market perceives today. What I would just say, if you look at the trajectory of our spending and our debt and the interest burden that we have, I think over time is through the rest of the decade, et cetera, we'll have to bring new buyers into U.S. Treasuries, and that will potentially have a risk of putting pressure on longer rates, unless we want to finance the whole Treasury stack at the front end of the curve, which would be a very, very significant policy shift.
Bloomberg's Romana Bersace speaking with Goldman Sachs CEO David Solomon. Okay, let's look at some front page news this morning. A look at what's making headlines around the world. First up, the New York Times leads with this. Puerto Rico's GOP chairman is demanding an apology from Trump after comics remarks on Sunday at Trump's Madison Square Garden rally. Tony Hinchcliffe, in an opening speech, referred to Puerto Rico as a floating island of garbage. The chairman said that he would withdraw his support from Trump unless he apologized for the racist remarks.
Next up, the Wall Street Journal leads with Jeff Bezos defending the Washington Post decision not to back a presidential candidate. It's an op-ed, and he said endorsements create a perception of bias. He admitted that the misstep of the decision's timing, says he wishes they had made the change earlier. A lot of billionaires changing their direction.
Yeah, a news cycle election really dominated by billionaires, Bezos, Elon Musk. Meanwhile, Bloomberg has this. Starbucks is threatening to fire staff if they don't return to the office. Basically, the policy says come into the office 3 days a week with exemptions available upon request, but they will implement a standardized process to hold workers accountable if they don't abide by the return to office policy. Manis, The obvious irony with this is that Brian Nichols, the CEO, when they appointed him, they let him live in California and just travel on the jet to Seattle. And at the time, Bloomberg reporting was staffers did not care where he lived as long as they didn't crack down on their own work from home policies.
Yeah, but this is one of those double twisters, which is he can work his schedule. But then look at what's happening at Amazon 5 days a week. You've got Dell, remote working, again, is really very much under question. But this is beautiful, isn't it? The CEO, private jet, can come and go anytime you want. I mean, why don't they just say he has a house, move him to Seattle, and, he can come and go as he wants to California? No, it's actually allow him some form of flexible working.
I always look at these things and say, it's just a way to cut costs. It's just a way to give an excuse to basically say, if you don't want to come into the office, we're going to let you go, and kind of an easy way to let go of workers.
Either way, it's whether you believe Starbucks is still your destination of choice to have your coffee when they say, welcome in.
No comment. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger alongside Manus Cranny. Let's set your agenda.
Treasury yields take a breather after a weak auction sales and the Trump trade pushed them higher. Alphabet kicks off this week's big tech earnings, $20 trillion in market cap, set to report in just 3 days. And leaders in finance gather in Riyadh. We'll bring you part of our exclusive conversation with David Solomon of Goldman Sachs. Danny, good morning.
Well, it is the week that Barclays strategists are calling a week of catalyst galore. 2-year yields 10 and 30 still under pressure this morning. 4.2% basis points yesterday moved for 10-year yields. A weak auction and betting markets increasingly implying the odds for Republican sweep, despite NYMEX crude falling 6% yesterday. It's a little bit higher today. S&P 500 basically flat, trying to put in another day of gains after yesterday. Tech stocks, those are under focus this morning. Those are outperforming. We have Alphabet earnings tonight, Microsoft, Meta tomorrow, Apple and Amazon on Thursday. And then we have to wait a month for NVIDIA, Manus.
You got them all in there. Bang,
it.
bang, bang, bang.
Were you impressed?
I was very, very impressed. It's going to come down to I fell over my P's in alliteration. So well done to you for your Amazons and your Alphabets. Look, it's a starting point, isn't it, about where we are. It seems as if this market is preparing for Trump, potentially hedging Harris, but it's, where do you start? And we just had a conversation with Seema Shah, and she said, look, the ability to really leg higher from here is a little bit more limited because so much of it is in the bond market and the equity market, the betting presumption of a Trump victory next week.
I just think expectations are so weird for this earnings season because we have been so focused on the election.
Yeah.
You get these really strange swings in equity markets. Barclays also mentions that big gain in Tesla really reset things for this earnings season, that people looked at that and said, wow, you can have blowout earnings. We've kind of been ignoring this and maybe we aren't prepared for it. It is a big week for tech. Should I do the calendar again?
Go with the calendar.
Okay. Alphabet kicks things
Alliteration.
off. It's Alphabet kicking things off today. Then it'll be Microsoft and Meta on Wednesday. Amazon and Apple on Thursday. All those alliterations just for Manus Cranny. Mads Petersen of Edge Investment Technology is staying optimistic about the earnings season and for tech. He writes, we are long tech, and the biggest mistake to make this year and this decade was not to be invested. Joining us is the man who is fully invested. It is Mads. Mads, thanks for joining us this morning. So what is at stake with these tech earnings?
Well, what's at stake with the tech earnings is everything. The market, the recovery, but it's also the drive of the technology as the positive change in the world we're living in at the moment, because these companies are making money, they're reinvesting them, but they're also converting revenue with low profits into revenue with high profits. So 100 billion made in technology returns much more profit to shareholders than in any of the other sectors. So it's more or less everything we know about capitalism which is at stake, not in this earnings season, but with this transition.
I love what you say, Mads. Good morning to you. Underestimating U.S. capitalism can be fatal, but the worst mistake now is not to have a plan to handle the coming corrections. Now, this is slightly contrarian. What corrections do you think we're going to have, and what triggers them? And that's much more important to me.
So what triggers them is uncertainty and the price of capital, typically. So people realize that they thought they knew how the world works, then suddenly you see in the price of capital that you didn't. And that means what I mean in normal language is if credit spreads, they widen, or if somebody has misplaced huge bets. And that's why the largest economic bets at the moment are in the tech sector, so they need to convert this into earnings. In terms of what's at stake is equity markets have moved up more than 100%. If we look at S&P 500 the last 5 years, so obviously sometimes within the next 24 months, we'll get a 20% correction. If things stop there, it's okay not to have a new strategy. We think that normally booms like the ones we've had lead to a bust, and people need to have a strategy how they hold on to their investments when markets go down 30 or 40%, or how they reduce their exposure. And with people having locked up a lot in private equity, they need to be more nimble and more active with their liquid portfolios.
Mads, you're talking about what happens at that event, how you handle risk, how you stick to your strategy. But do you do anything to prepare? Is there anything that is a useful hedge in a market where bonds, usually the state asset class, have swung back and forth with both positioning and prices throughout this year?
There is exactly these bonds because they just moved up 40 basis points, and now they're actually a good hedge again. So it's just a question of not over-putting too much money into the bonds because the central banks have made these bonds very volatile. So the first thing you need to do is you need to map out your plan so you know what you're going to do if things go wrong. For example, we have strategies where we hold 99 or 100% equities. And I have written down a long time ago, what is it we're going to hold when we only hold 20% equities in these strategies. You need to have a plan. If you write it down, it's easier to change it. Secondly, government bonds in the US will be an excellent hedge if we get a recession. They'll be a better hedge now than they were a month ago. The art of the game is to not go into them too early.
What is it that provokes you to prepare for a 20% drawdown in liquid assets in the next 24 months? That's really what I want to get the rub to, because the consensus in the market is no landing, soft landing. I mean, you take your choice of what phrase you want to use. But solid growth, 3% growth in GDP, solid growth. If there's a Trump victory, you get more fiscal expenditure. So what is the grenade that triggers a 20% drawdown?
Well, the whole point is that you're absolutely right. The growth story is even better. It's 6% nominal growth. But we didn't see it last time it happened. We didn't see it the previous time. If we talk about the tech collapse, and if we talk about the great financial crisis, and obviously the pandemic, well, it came out of Wuhan, but it also came out of the blue. So, it's not a question of knowing where it comes from. It's a question for being ready for the unknown. If you think you know where it comes from and you're super cool, then you're the worst possible risk manager, or if you drive a car, the worst possible driver in the world. At the time when you're not alert, that's when you can really hurt yourself and your passengers or your co-investors. So be ready for what you don't know, but look for the signs. Look for example, we have a lot of problems in CMBSs at the moment. Will these stay contained? Will credit spreads stay low and support growth, or will they go worse? Will the Chinese be able to implement a plan in the coming months, or will they another time, like they did the last 2 years, talk a lot, bet all their money on the market, and not be ready to actually support the consumption side of the economy? Those are the three main things to look out for.
Mads, just that China comment really emphasizes that the U.S. is standing alone in the type of strength that it has. It's the American exceptionalism. Is there a point where soft growth in the rest of the world, be it China, be it Europe, be it developed markets, developing markets, impacts the U.S. and impacts the attractiveness of multinational companies?
Yes, there is a time, but until now, as long as it's only on the margin, it's actually a positive because it creates a deflationary input to a U.S. which has had a very inflationary policy. First, there was the printing of the money and the low interest rates, and now there's the very strong fiscal policy. Imagine if China had been growing anywhere close to what they say they have been growing, or even to their historical growth. If Germany had grown at 1.5% and China had grown at 7%, the US would not be able to grow at 2.5 to 3.5 without huge continued inflation. So until now, there's an impact. It has been positive in the sense that it has kept inflation down. And the US economy is still primarily a closed economy. There comes a time when the US will pay a bill in terms of political consequences, and that's the time at the moment. So For the time being, it has been a positive consequence when the rest of the world, if the rest of the world reaccelerates. And remember, we have a 120 years history where the US have actually consistently done better. So it's not a short time period. But if the rest of the world rebounds, the US will have to slow down.
Okay, Mads, thank you very much. And we finish where we started. Underestimating US capitalism can be fatal, given the context you've just laid out. Mads Petersen of Edge Investment Technology. Coming up in the show, Danny and I'll talk about Apple. It's leaning less on China and getting more iPhones from India. Context matters on Bloomberg.
Donald Trump spends full time trying to have Americans point their finger at each other, fans the fuel of hate and division, and that's why people are exhausted with him.
The newest line from Kamala and her campaign is that everyone who isn't voting for her is a Nazi. I'm not a Nazi. I'm the opposite of a Nazi.
That was Vice President Harris and former President Trump in their final stretch of campaigning with just 1 week until the election. Mike Shepard is tracking the trail of both candidates. Mike, look, when you look at this, this is going to be a real frenzy, a mad dash to the last line. We've got a freedom rally. We've got her closing arguments this evening in Washington. I was brought to look at Henrietta Treyes from Vita yesterday. She said this is all about the fight for the suburbs, and that's where she should focus. This is where Hillary Clinton didn't focus in 2016. So how targeted will Harris's campaign be in these last days of the campaign?
Well, Harris will be aiming tonight's message at exactly that demographic, the people who would balk at a return of Donald Trump to the White House, but might still be reluctant to vote for Kamala Harris because they either say they don't know her or have other misgivings about perhaps voting for a Democrat. The backdrop of this event is purposeful. She's speaking from the National Mall on the Ellipse. It happens to be the same location where Donald Trump gave that infamous speech right before his supporters stormed the U.S. Capitol on January 6, 2021. So she will be trying to be drawing a contrast between herself and that moment, and then more recently, Donald Trump's own closing argument given at Madison Square Garden in New York on Sunday, where we saw a number of the warm-up speakers invoking racist and misogynistic language, the very kind of divisive conversation that Kamala Harris pointed to in the remarks ahead of our conversation now.
Shep, it's been remarkable with that MSG appearance. The kind of nothing matters crowd all of a sudden woke up and said, maybe this is something that will break through. So what does Trump do from here? What is his plan? Where is he speaking? Does he need to do some course correction after Sunday?
Well, we saw in his remarks last night that he already was on the defensive. He even had to say, I am not a Nazi. I am the opposite of a Nazi. And his supporters also have had to distance themselves from some of the worst of the remarks on Sunday afternoon and evening. Yet they're going to have some work to do in reaching back out to some of the groups that they have spent months trying to cultivate. And that includes black voters and also Latino voters who now might be turned off a little bit. And you might think that a handful of votes here or there, well, what's the difference? In an election as close as this one, every vote really counts and really matters, especially in these swing states. And Trump will be in one in Pennsylvania today. This is one of the key battlegrounds, and they can't really afford to lose any support anywhere.
No, well, he was evangelizing, excuse the pun, in terms of early voting. He was in front of a faith crowd yesterday in Georgia, and it really was about Republicans getting out and voting early. You talk about Pennsylvania. A Philadelphia district attorney is suing Elon Musk. This is over his $1 million, you know, the draw, $1 million if you sign up on the petition. How consequential is that? Because I can hear the drum roll from the other side, which is, you know, it emboldens the Trump base by taking this action now. What are the consequences of this suit?
Well, for the short term, it's not going to stop Elon Musk. His super PAC and Musk are indicating that they have no intention of stopping. But the whole notion of this $1 million lottery to try to get registered voters out there and encourage their participation in the election had drawn scrutiny not only from the Philadelphia District Attorney, who called it an unlawful lottery, but also from the U.S. Department of Justice, which had expressed concern in a letter to Musk's super PAC that it might be in violation of U.S. election laws. So we'll have to see how that unfolds on a national level, but we probably won't have a resolution until after the U.S. election next week.
Shep, it is remarkable how much this election cycle has been dominated by news of billionaires. Jeff Bezos, the recent one, after spiking what was a drafted endorsement of Harris, he wrote an op-ed yesterday trying to defend that, basically saying they do nothing to tip the scales in an election. It just creates a perception of bias. The number I think NPR was reporting was 20,000 subscriptions canceled from the Washington Post. What does this tell us about where we are right now?
Well, this is yet another twist, just like the lottery we were talking about, in a historically chaotic and unpredictable election. And in this case, nobody had it on their bingo card that the Washington Post would not endorse a candidate. They have been doing so ever since 1976. And some of the reasons that Jeff Bezos gave in justifying the decision was that he was worried about the perception of bias, saying that an endorsement would create the perception of bias. Yet across the Post newsroom, there have to be concerns that, hey, wait a minute, we have been reporting hard on the former president and his plans should he return to office. And if you are not going to endorse, you are besmirching our work. And I should note that I worked for more than 20 years in that newsroom and have many current former colleagues there and understand some of the fear and loathing that they're going through right now in this moment.
Yep, a newsroom you're very familiar with. Shep, thank you so much. That's Bloomberg's Mike Shepard. Okay, some corporates we're keeping our eye on this morning. Apple is increasing its reliance on India, shipping $6 billion of iPhones from the nation and reducing its dependence on China. Joining us with more is Bloomberg's Sunkulp Fertial. Sunkulp, this is a story that's been ongoing for some time. Just how much further away has Apple moved from China at this point?
We reported last year, India's fiscal year begins in April and ends in March. We reported last year that Apple was making around $14 billion of iPhones in India. That's the total production we're talking about. So Apple has very steadily but very quietly increased their reliance on India. And they now make just under 10% of their global output from India. So this is a huge step for them. And, you know, we're just talking about the elections. If Trump comes to power, India would be a great base for Apple to rely on.
Well, in terms of product and delivery, they may well be moving away from China, but they're also starting to roll out their AI product on a number of devices. What do we get? How's it going to change my life?
So the AI rollout is yet to come out in India, but I mean, we all know that they're using OpenAI. For now, I don't think generative AI changes your life drastically. It's more of a very powerful search engine. You can write poetry on it or ask it to tell you the latest, but I mean, I don't think it's going to transform your life as of now, to be honest.
Okay, well, I don't think I'm going to rely on it too much for questions for CEOs. But you never know. You can always run it through and see what they come up with. Sunkulp, thank you so much. Sunkulp Fertial there on the Apple story. Big day for earnings. Tech earnings are in focus this afternoon. We're also going to get a slew of other reports before the market opens. Pfizer is one of those, with investors looking for improved profitability as the company cut costs and reorganize themselves. Sam Fazeli is with us for Bloomberg Intelligence. Sam, they've got an activist investor on board, which is Starboard. So the pressure is on them really to deliver. What do you think the activist investor and the market are looking for in this set of results?
Yeah, so good morning, Manus. I think we've seen a presentation from the activist investor, which is a long-standing activist investor that has, as you know, and everybody knows, and been following the story, taken an interest in Pfizer. If you look at the presentation, I can't really walk away from it and say, oh, yeah, that's a good point. It's all about the company should do better. Management should do better. Of course, you can tell by the share price that the company needs to do better. So there are no real solutions in there. What the market's looking for is how is Pfizer going to grow as it's fighting a declining COVID business, and also it's got some patent expiries coming up. So we need to see the pipeline highlighted more, and maybe the market's looking for more M&A. But they've done M&A. Some have worked, some have not worked. Some look like pretty good deals, like not in terms of value, but Seagen necessarily. Seagen, the one that they recently did, does bring a pretty good pipeline. So what we're looking for actually for this 3Q number is how have they done with COVID, the two products they have, the vaccine and Paxlovid, and what does that mean for the full year?
What about leadership? What about executives at Pfizer? Are they under threat? It seems to be an odd back and forth with the activists as to whether they're attempting to push them out or if they're behind them.
Well, they didn't really specify anything as drastic as that, Danny. But even if you change the CEO, let's say that's one of their options, it doesn't really make an immediate difference to the share price. I don't think that the world believes that Albert Bourla is single-handed responsible for the share price moves in Pfizer. There are many other issues that impact a pharma company in the R&D world. A lot of serendipity. They have had a streak of setbacks, but I think you can't just by changing the CEO, you can't guarantee that you're going to change that.
Okay. Sam, thank you so much. Those earnings coming before the bell, shares higher this morning. Sam Fazeli of Bloomberg Intelligence. Coming up, we will set you up for your trading day.
I think there's an awful lot of attention on short-term rates. I'd actually be focused over time on longer-term rates. And I continue to be concerned about the level of spending and deficits in the United States. I don't think that's a short-term, crisis factor. But unless we have policy change and get our spending and our debt under control, ultimately that's going to have a bigger impact on long-term rates than I think people are anticipating today.
Part of Bloomberg's exclusive interview there with Goldman Sachs CEO David Solomon at the Future Investment Initiative Conference in Riyadh. Check out more of that on the terminal and Bloomberg.com. Okay, let's take a look at what's ahead today. Set you up for your trading day on this Tuesday. Pfizer and PayPal both will report earnings before the bell. Plus, economic data. We'll get JOLTS numbers. That comes at 10 a.m. More earnings then after the market close. Alphabet, AMD, and Reddit. I'll report, Manos.
Yeah, log into your Reddit account, see what's moving. One thing that is moving is Bitcoin. Have a look at this. We're trading above 71,000 for the first time since June. The money's flooding in. If you want the very personification of a punty Trump trade, this maybe is it. $3.6 billion net inflows in October. And the options market, ring a bell. They're looking for $80,000 by the end of November.
I think one of the keys for this trade and why it's gotten another leg higher after the rally is because the betting markets have started to change, not on Trump, but on a red sweep. Something like a 48% chance on some of the poly markets showing that. And that's when you could really get some of these policies come in. So if you're looking for a reason to trade, that is what this market is keyed in on.
It's amazing how we move from, sort of decrying poly markets 10 days ago about the whales moving them. And then it actually comes back and reinvigorates everything. Anyway, they'll take you through the rest of it on surveillance. That's it from us.